Good day, fellow investors. Meta stock has been on a wild ride over the last year. First, 76% down, and now a staggering 200% up. It went from 100 to the current 344 as nothing had happened here. But now the P ratio is 31 and the market cap is 885 billion. For me, I told you to buy here, but for me now it is simply too expensive. I've looked a little bit at the presentation earnings last one, and yes, things have been improving across the board with a little bit of growth in revenues, but they are investing 30 billion per year in the Reality Labs revenue and everything, and that is not gaining traction. Actually, it's going lower and lower. So that they might say quest this, quest that, it's great, but it's just too much of a bet in my eyes to just have it out there like it will be something. It might be something, but it might not be something. At a P ratio of 10, I was saying you are getting that for free, that bet. At a P ratio of 30, you are risking too much on a bet. They have really cut on expenses, which was an issue a few years ago. Then, as they cut on expenses, you can expect a scandal going forward, and then that's the normal cycle of Facebook. Cutting expenses, lowering investments, delaying investment in AI and the metaverse, of course, pushes net income higher, which is something that investors like. And you can see here also lower capital expenditures. But this is something that I don't agree with Facebook. Family monthly active people, 4 billion people. Now, I have checked the population. Okay, let's say 8 billion, 7.8. 3 billion people don't have access to internet, which means that this minus 3 billion is, according to my maths, 4.8 billion. If we take away youth, that's around 3 billion, 3 something, but Facebook says 4 billion people. So every person out there that has an internet connection is using Facebook. Okay, double accounts, but they say they have complex techniques, algorithms, and machine learning models that seek to estimate the underlying number of people using these products. Okay, they want to show growth, growth, growth because that's important for Wall Street, but Facebook is turning into too much of a Wall Street pleaser. And if I look at the cash flows, they're also repurchasing stocks heavily. So 2021 they spent 50 billion on repurchases, then a little bit less, and now also 26 billion on repurchases, reinvesting. And that, of course, when you spend that kind of money, it pushes the stock higher. 2021, most money spent, then likely a little bit less now than again, but that's not enough. Of course, 30 billion on a market cap of 800 billion is significant, but in my eyes, Facebook is simply Meta too risky now because, yes, now it's priced like the others of Magnificent Seven. We discussed Google a little bit cheaper, but it doesn't have the risk and reward attractiveness now as it had a year ago. Price has changed, the fundamentals of the business haven't.